Hi, this is Pastor Lutzer of Running to Win, heard daily on Bible School Radio, 91.3 KDKR, Decatur, Dallas, Fort Worth, and on 91.3 KYJC, Commerce.
Portions of KDKR programming do not necessarily reflect the views of this station, its management, or staff.
Prudent Money with Bob Brooks is sponsored by the Prudent Money Foundation on 91.3.
Well, how do you invest for an uncertain future? Today we're going to take a look. Stay tuned for Prudent Money. Good afternoon, this is Bob Brooks, and you are listening to the Prudent Money Radio Show. Thank you so much for joining me today. You know I do appreciate it. Well, how do you navigate in such uncertain financial waters today? Author and financial advisor David Wright is here to give us his take, talk a little bit about his book, Bonfire of the Sanities. David, welcome to Prudent Money.
Thanks, Bob, for having me.
Well, the best place to start this, because I always get interested, is how you came up with the title of your book. I'm sure you haven't gotten that question before. But tell me a little bit about Bonfire of the Sanities.
Well, it seems like our economy and our world has lost its sanity.
Yes.
Especially the past few years, don't you think, Bob?
Oh, definitely.
So the book title came up from a book that Tom Wolfe had published about 30 or 40 years ago, Bonfire of the Vanities, but it's a take on that title. Basically, it's a money book talking about how you can reset your portfolio for today's financial lunacy, and there's a lot of financial lunacy that's out there today.
There is, and you know it's interesting as just a everyday investor trying to figure out what's real and what's not.
It really is true. I mean, first of all, I want to make very clear to you that you can only worship one master, and that's our Lord and Savior.
Yes.
It's not about worshiping money.
That.
But most people that I find that I talk to, Bob, that are heading into retirement or getting maybe within 5 to 10 years, they need to understand that it's making sure that you know what the purpose of your money is. So this is very much a hands-on purpose book about what money is for. People want to have a comfortable retirement. They want to have a retirement that doesn't involve worrying about where their next paycheck's going to come from. They want to make sure they can continue their life goals in retirement, which include money and non-money goals. So in a fun and entertaining way, we kind of use music in this book to go through all of the ups and downs of planning for retirement.
Well, as you would agree, there are a lot of opinions on where the market is heading, and just confuses the issue. You know, one thing that we can depend on for sure is uncertainty. How do investors face
right.
the future in a stock market that is very uncertain?
It certainly is, and I think a lot of it has to do with the fact that a lot of our government believes that the answer is always to print more money.
Yes.
And they've certainly done that the last 3 or 4 years, and of course that goes all the way back to the late 2010 time period in 2008 and 9, when unprecedented trillions of dollars were printed in response to our economic crisis of 2008, and then of course in COVID in 2020. We had the same thing happen. So when you produce a lot of money that doesn't really have any financial backing to it, and then at the same time you make the cost of borrowing or using your funds in credit cards at 0%, and you do that for any length of time like they did during COVID, it's resulted in this market that isn't really real. I call it a faux market.
Yep.
It's hard to predict what the market's going to do next because nobody really knows what the true value of anything really is.
Well, and nothing makes sense. You know, you talked about COVID in 2020, and I always refer to that February, I think it was February to March downturn as the COVID crash. If you had just checked in and you said to me, Bob, this, and this has happened, I would think that we were on the verge of 1929 And of course, it didn't turn out that way. But how, has everything changed to the point to where things are different this time, or do you see something larger playing out?
I do see something. I mean, everybody says this time will be different. We're going to avoid the hard landing. Of course, 2022 was not a fun year. We had a retraction, a pretty severe one, but not the one that a lot of people prognosticate that could be the 1929 crash. But they seem to always just jump to the easy answer, which is to print more money. Modern monetary theory just says they're going to print more money. But at what point do we cross that red line where printing too much money has completely dissolved and devalued the value of our dollar? And I think right now we're kind of at that point. We're getting closer all the time with, I think, looking at the wealthiest of our country and the poorest of our country, where those two extremes, Bob, I believe, are getting further and further apart. And this is just part of the whole process of what's going on in our government now. The rich are getting richer, the poor are getting poorer.
One of the things that I like about your book, David, and fully recommend this as a great learning tool, is that you give both sides of the story. We talk a lot about pop culture finance on the program, and how that's just they tell you this is how you're supposed to believe. If 1 + 2 always equals 3, well, sometimes 1 + 2 = 5, and you got to really determine what's going on. But something that you wrote about, which I deeply appreciated, because I just think this is such a one of those things that you really need to know as an investor. You talk about cycles in the market. Talk about how cycles work.
Well, there's basically two major cycles in a market. There's bear market cycles, which of course are the ones you want to avoid, where basically for any number of years, in some cases as many as 15 to 20 years, a stock market's going to go up, down, sideways, but basically over a period of 15 to 20 years, you may have not a lot of growth in the market. One period in time where that happened was 1966 through 1982.
Yes.
The market, the Dow Jones at the time, was at 1,000 points, and 16 years later, by golly, it was still at 1,000 points. So those are the bear market cycles, and unless you're in a dynamic portfolio where you're constantly making changes and selling when it's high and buying again when it's low, it's tough to make money in that period of time. If you don't know what you're doing, if you're using your money, you're going to be selling a lot of principal and maybe even running out of money before running out of life. The bull market cycle, which is the cycle we all know and love, the best bull market cycle came between 1982 and 2000, where our Dow Jones went from 1,000 points to 12,000 points in that period of 18 years. Pretty incredible growth. But at 2000, then all bets were off. 2000 to 2013, two major drops, two major recoveries, and then, of course, where COVID came in. So it's hard to map out your retirement strategy knowing that you've got the chance of being either caught in a long-term bear market, or if we all could be so lucky to retire at the beginning of a bull market and have that bull market go for 15, 20 years, we'd be all so lucky to be able to just spend down our money and know that every year it's going to be replenished by the stock market going up, when we know that just isn't reality. It's not what really happens.
If people could just learn, if you had 10 things to learn about how invest, that would be one of them, because if you listen to the CNBC of the world, we don't have bear markets anymore. These are periods of volatility. You know what the heck does that mean? So it's kind of humorous when you look at it. But you talk a little bit about retirement planning, the key time period, 5 to 10 years ahead of time. What are some key aspects of planning that should be taking place?
Well, you certainly need to take a really serious look at your budget. What are the want goals versus the need goals? A lot of people plan for retirement just with the bare minimum in mind. and they're not thinking about inflation. They're not thinking about the possibility of a black swan event like COVID or like the financial crisis. So 5 to 10 years out, really take an honest look at what things you will need to have coming in the door when you retire. Will the mortgage be extinguished? Will your credit cards be all eliminated by that time? How about your car loans? Putting that together 5 to 10 years out, knowing your sources of income. What do you get in the way of a pension? Most people in the Midwest where I live don't have a pension. They're not fortunate enough to have gotten one. So what's a Social Security going to be? When should you draw Social Security? At what age do you want to retire? How about your investments? And that's what this book really focuses on, is the investment part of it, because most people that come to my door, they walk in and they go, I say, what's the purpose of your money? And they go, well, I want to make money on this. Well, all right, everybody in the world, Bob, wants maximum return for minimum risk.
Right.
But I ask them, maximum return for what purpose? Is it for a house or a boat, or is it for income in retirement? So that's what we want to focus on, our portfolios generating honest to goodness income from interest and dividends that can last a lifetime.
I'm talking to David Wright, a great book that we'll have up on the recommended reading list on the prudentmoney.com. You can go check it out, called Bonfire of the Sanities. And you talk in the book about one of my favorite arguments that comes from pop culture finance, which is buy and hold investing. You know, they preach the virtues of buy and hold. And buy and hold is a good strategy for sometimes, but sometimes it's not. So, you know, what are your thoughts about buy and hold investing?
Well, I think buy and hold investing has its place. It certainly does for those individuals that may perhaps have money that is for a long-term need. It might be for a legacy for your church. It might be for your family or your children or grandchildren even. Those buy and hold strategies, you don't want to sell low and buy high. You want to do the opposite of that. So obviously, long-term horizon, when you have 10 to 20 years to invest, buy and hold strategies certainly work. Why? Because if you're constantly buying during that period of time, you're buying sometimes when the market's up a bit, you buy less shares. Market falls, oh well, no problem. I'm still buying. I'm buying low. But over that period of buy and hold, you're actually doing something called dollar cost averaging. Every advisor in the world embraces that theory. I do too. Buy low and sell high is a beautiful thing because you end up buying shares at a discount. It's when you get to retirement or near it that the buy and hold strategy will work if you are in investments that kick off a dividend or an income, an interest, something that can allow you to use your portfolio for income first without doing what? Selling shares. If you start selling shares in retirement to live off them, then you're going to be cannibalizing your portfolio, and that's what we want to avoid. Don't cannibalize your portfolio. Let's not eat the chickens. I just want to live off the eggs of those chickens. I don't want to eat the chickens. I want to live off the income or the eggs of those chickens. So it's very kind of corny, but people kind of get that analogy when I talk about money, you know, and what it means to you.
So, you know, managing risk is the name of the game. You know, you're talking about that right now. You refer to it as the new reality. Talk about how you would go about taking risk at retirement. I mean, we got to take a little bit of risk at least for growth purposes. But you know, how do you do this, because it is a new reality?
It certainly is, and that's why I believe if you're looking at long-term investing, even in retirement, it's okay to take some risk, but take some measured risk. And it's more important today, in my opinion, to know what you're investing in. If you're going to take a long-term view of something and say, you know what, this has got more volatility, it's got more potential for gain, but also has some potential for some low points, maybe for some oopses in there. So if I'm going to do that, first off, I'm not going to do it with more money than I know would cost my retirement. I'll use a portion of it for long-term solutions, but I know then what I'm specifically investing in because I'm using more individualized portfolios where I know some of the names in there. I know some of the investments that are part of that circle. Because right now, there's a war of politics in our world as far as, are we going to go green energy? Are we going to stick with fossil fuels? Are we going electrical vehicles? Are we not? So all of that whole circle of political unrest, geopolitical concerns about investing, you need to know specifically what you're invested in to, number one, make sure, is it something I believe in? Number two, is it going to be something that's going to be voted out of the next political election? How you invest is a function of what you're investing in, and that's why you should work with a specialist that's an income specialist that is also tuned into the growth world so that you know specifically, are you in something that has teeth? Is it going to last a while? Is it going to be something that's going to be a flash in the pan? So I agree with you. Risk in the portfolio is great, but investing on a more individualized basis, you know what you're getting, and you can act quicker.
Once again, the name of the book is Bonfire of the Sanities. David Wright has written it, and a great resource. I recommend that you take a look at this book. You know, one of the things that you point out in the book is that there is good news, bad news aspects of retirement, and one of those is the good news is people are living longer. The bad news is people are living longer. Talk a little bit about that.
Absolutely. I mean, mortality is actually improving in our country, despite what you hear about fentanyl and all the other stuff that's out there. But the morbidity is increasing. The cost of nursing home care, home health care, certainly has been on the rise, and more people claiming on those types of coverages. And the average length of stay in a nursing home could bankrupt most people. So it's important to understand that having staying power in your investments is important, not just from a standpoint of, gee, I want to have money for the rest of my income from retirement, but I want to have the ability to maybe do double duty with this money if I've got some funds that I can invest for long-term care, something that would protect me if I'm being cared for at home. The reality is, if you're in a higher income bracket, higher net worth bracket, you might be almost able to self-insure if you're over a couple of $1 million in wealth. But if you're below $1 million to $250,000 in investable assets, you might want to look into long-term care, because that's certainly something that could very easily bankrupt you and or your surviving spouse. If you're married, would be an awful situation to watch your net worth just kind of erode.
You know, I get probably the one subject that I get the most questions about, and I just want to get your opinion on it, is Social
Sure.
Security. Will it be there, in 10, 15, 20 years? And so what are your thoughts on it?
Well, if pro was the opposite of con, progress is the opposite of Congress. It seems I say that tongue-in-cheek. It kind of gets some laughs at my workshops, but it's really true. Congress has to get off their duff, and they really need to put together a responsible Social Security bill that takes into consideration some concessions. I think for our generation, and Bob, I don't know your age, but I'm in my mid-60s. It's a foregone conclusion that our Social Security should be stabilized for the majority of the rest of our lives. But
Yes.
The generations below us, we're looking at major cost cuts to Social Security in 2031, 2032, unless Congress starts making some serious decisions about balancing our budget. We're spending $2 trillion more than we're bringing in. You can't do that and maintain a Social Security viable system. That system will be broke in shorter than 10 years from now. Our trust fund is dwindling away. So here's the thing, though, the hope that I have. I believe that in our country, Social Security is that sacred cow. That's not something I think they can just fritter away and say, well, oops, we don't have it anymore.
Yes.
Because a lot of my clients, Bob, that are even in the middle, let's just say middle wage earners that have a decent portfolio, not enormous, but kind of in the middle, maybe between $500,000 and $1 million, are so dependent upon their Social Security that I believe that they're going to have to find a fix for this and find a fix very, very soon, because there'll be people walking up the Capitol steps if they don't have their Social Security. We will truly become a third world country if Social Security were ever to fully go away, and I believe that with all my heart.
And politics, being what it is, there's no president that wants that to fail on their watch. I mean, I think I agree with you. I think that maybe it's a little bit of an adjustment in the payroll system or something, but it's definitely something that can be fixed or at least mended for a good period of time. It's interesting, though. I mean, but it's a political hotbed, and we'll have to see how all that fun that comes out. You write, it's funny, David, as you've been talking through the interview, I just kind of sit back and think to myself, is that how tough it is to go through this process. There's so many things that you have to consider, and how important being matched up with the right financial advisor, how important that is. And in the book, you write that, some advisors are actually putting their clients in harm's way. Talk a little bit about that.
Yes, we have a report that we run for every potential client that comes into our door. And a lot of individuals just aren't aware that in their eve of their retirement, they have investments that they're holding right now that is, as recent as 5 years ago, had a decline of 30 to 40%. To 2008, perhaps 40 to 60%. And I always ask them a question. Do you think, generally speaking, does history usually repeat itself? Some people say no, but I will tell you the great majority of people say, yeah, you're right. It does seem like history has a tendency to kind of circling back and repeating itself. So if that were the case and you knew you were getting ready to retire and you had a portfolio and you knew that portfolio, was not in a position where it could sustain itself if we had another black swan event like COVID, and secondly, you knew that it really wasn't generating much in the way of dividends or interest, well, wouldn't that concern you, knowing that your portfolio could have to be used when it's down? That's the worst thing. That's what kept me up at night during my 35 years of doing this, was worrying about my retirees before I embraced, some of the principles of this book, how people were going to be lucky enough to survive through 20 to 25 years of market ups and downs, knowing that they needed money every month from their investment to live on. How was I going to somehow replicate money that they lose if it's a bad year if I have them in the wrong investments? So true. A lot of individuals, Bob, also are do-it-yourselfers. They attempt to eliminate any advisor because they don't believe they have the right motives, so they just watch the YouTube version of how to invest and they do it themselves. But then they don't understand there's two phases: accumulating the wealth, distributing the wealth. When you distribute the wealth, it takes a little bit different discipline than building the wealth during the accumulation phase. So we do, I think, a pretty good job of explaining to our clients what are some of the tools that help measure the volatility of your portfolio and the usability and reliability of income of your portfolio with some diagnostic tools. It's up to them to decide what they're going to do because, everybody has their own choice of how they want to tackle their retirement.
I'll tell you this. You said you've been in 35 years. I've been in 31. And we've seen a few things.
We've been around, haven't we, Bob?
If you think about it, and it's amazing that we could do that and still be in our 30s. So once again,
I love you, man.
The name of the book is Bonfire of the Sanities of David Wright. Just great to have you on, David. I'd love to have you on again because I didn't even get in through half the things I want to talk to you about. But once again, Bonfire of the Sanities. David, good luck to you. This is Bob Brooks.
Thank you so much,
and
Bob.
You are listening to the Prudent Money Radio Show. If you had a question for me, please go to the website at prudentmoney.com and send it in because we are all out of time. Till we do meet again next time, keep the faith and have a great rest of the day.
That's all the time we have for today. Questions or comments for Bob, or to find out more great information like what you've just heard, visit www.prudentmoney.com. Be sure to join Bob Brooks again for the next edition of Prudent Money.
Prudent Money with